The recent case of Gemeentes Hertogenbosch reiterated some previous decisions about recovery of input tax by public authorities. On the face of it, the case is about Article 18 of the Principal VAT Directive, which allows member states to impose a self-supply charge where goods are put to exempt or non-business use after they've been produced by a taxable person, generally recovering input tax on that production because there will be a taxable self-supply. The output tax on the self-supply becomes input tax, as if the goods were bought in from someone else, and so the output tax is recoverable again according to the normal rules, based on the intended use of the goods after the self-supply. The sort of situation described in the case is shown in this diagram. A public authority owns some land already and engages a builder to construct a building on it, which the authority then puts to its own use. Public authorities, of course, have mixed uses. Some of their activities are outside the scope of VAT, some are business and taxable, and some are business and exempt. It's that mixed use that was the point of this case. The operation of Article 18 is reasonably clear. If the member state has implemented the provision, which the Netherlands had, there's an output tax charge at the point that the public authority puts the building to use. The valuation of that output supply is subject to rules which are beyond the scope of this lecture, but the idea is to charge the same value that would otherwise be subject to VAT if the authority had bought a finished building from someone else. Because the output is taxable, all the related input tax on getting to that point is deductible, on whatever was paid to the builder, and possibly on what may have been paid for the land. If it was building land, or if an option to tax had been exercised, VAT might have been incurred on the value of that land. However, it seems likely that the land had been owned by the authority for some time, and there probably wasn't any input tax to recover on that. The question before the court was how the self-supply output tax could be recovered as input tax, how much, and when. The authority wanted to be treated like a trader, who until recently had a choice on acquisition of something for mixed business and private use. If there was an input which was at least partly related to the business, the trader could deduct the whole of the input tax immediately under Article 168, or else deduct only a fair proportion to reflect the proportion of intended business use. If the trader deducted all the input tax, then that represented a decision to treat the whole thing as an asset of the business, and if the trader then put the goods to private use, not taking them out of the business altogether, but just using them continuously while they still remained a business asset, then there would be an output tax charge in each return on a deemed supply of services under Article 26. This effectively claws back a fair proportion of the input tax originally claimed, so over the life of the asset, only the business use proportion is retained. This choice was confirmed as being the trader's right in the case of Lennartz. It would generally be beneficial because it would give a cash flow benefit up front and effectively provide an interest-free loan from the tax authorities when compared with only claiming the business use proportion at the outset. Relatively recently, Article 168A has been added to the Principal VAT Directive to allow member states to restrict the use of the Lennartz choice in relation to some purchases, in particular buildings. But that post-dated the facts in the present case. In effect, the authority wanted to use Lennartz here, getting that cash flow benefit. However, the Court of Justice looked back at an earlier case in which the situation was slightly simpler and the logic was therefore a little easier to work out. If a public authority buys an input and then puts it to non-business use, can it claim input tax and then account for output tax on a deemed supply? It's a question of the order in which you do things, the chicken and the egg, or the horse and the cart. The court held that for a trader, the starting point is that something bought for the business gives rise to a deduction under Article 168, and if that is then put to private use, Article 26 charges output tax. But an intention of private use can't be used to justify a deduction of input tax in the first place. There must be a connection to the business, however small, that will allow the Lennartz choice. The output tax that would be charged under Article 26 is not itself business use. This was confirmed by the Court of Justice a few years ago in the VNLTO case. The public authority in such a circumstance couldn't apply Lennartz, but could only recover the percentage that would be justified by its intended taxable business use. In the present case, which I won't try to pronounce again, the same principles applied as in VNLTO. The intention to use the building meant that the inputs incurred in constructing it were deductible as they were incurred, because there would be a wholly taxable self-supply under Netherlands law. The Netherlands had decided to implement that part of Article 18, so that was 100% taxable use of the building costs. However, the self-supply charge was recoverable only by reference to the future intended use of the building, which was 94% non-business, 5% taxable business, and 1% exempt. Only 5% of the self-supply charge could be claimed back.